We're gonna test out we're gonna test out the competition this year, man. We're gonna shoot for bigger competition this year. That's what we're gonna do. All right. And stream link is at the top. Y'all said y'all ready? I'm ready. Let's make this happen. Um, I do want to say one thing though. It does seem like there's more trading and investing sessions coming back to Clubhouse. I think that's a good thing. You know, so it's a good thing. I see more folks popping up. Um, they almost let it die. They almost let it die. No, okay. So mastering volatility, mastering volatility. Um, the most important things that I could think of, I packed into this study guide. Uh, Man, like I said, it's very extensive. We're gonna do as much as we can. Y'all gonna have to treat this like a wrestling match. Y'all gonna have to tap out when y'all tired. All right, just tap out when you're tired. All right, because I'm gonna try to go through as much as this possible. Look, Anisha, Anisha, I don't think we've ever had an 8-page study guide, have we? Well, no, there was that one.
Already tapped out.
You started reading through it.
No, I'm just playing. I'm just saying. You know how it is.
I know.
Let's just start it because I'll be out.
All right, so we start with the philosophy and the physics of price movement. All right, so this covers the difference between magnitude and direction. All right, magnitude and direction. So to trade professionally, got to shift that mentality, right, from prediction to probability. And that's one of the first things you got to learn. It's like let's not go into trying to be, like the predictors of markets, right? Let's understand the probabilities of things working out and dive into that. So amateurs, they obsess over where the price is going, the direction and whatnot. And then professionals, they more so obsess over how much the price is likely to move. So you'll notice we may trade some of the same strategies you see from anybody or everybody. We always trade them in a slightly different way. Our opening range breakout strategy, it's not just break the high. It's also you know break the high and clear this key level here. And as we saw today, also don't be so overbought when it happens or oversold when it happens that we can't even believe you got much more coming, right? So it's the magnitude of the price movement that we're looking for. The rationale here is that direction is binary; it's up or down, and often it's subject to noise. Magnitude, however, is statistically quantifiable. By focusing on magnitude, you can structure trades where you profit from movement regardless of direction, right? Or structure risk management that adapts to the market's current energy. So, in other words, even if you get directional, you can still, even if you were to take a directional trade, you can still use volatility to your advantage and, set yourself up for success by making sure that the noise in the market doesn't take you out. All right. So this week with the Pro Pivot Indicator, we made a few major adjustments to deal with a little more noise in the market, right? And by deal with a little bit more, that means eliminate more, right? A little more noise in the market, and you know, and I got another little surprise for y'all built into the Pro Pivot Indicator. It's literally hidden until it's not. Like it'll pop up, you know. Now I'm gonna see where it's gonna end up in the long run, but I think you guys are gonna really love this, um, because now you don't have to really, you don't have to identify these little small signals, right? Now, defining volatility. Formally, volatility is the statistical measure of how much a security's price or return spreads out or moves up and down over time, right? Now, in finance, this is most often calculated using the standard deviation or variance between returns from the same security or the market index, right? Now, why is this essential? It quantifies risk. High standard deviation means prices are spread over a wide range. A low standard deviation means prices are bunched together tightly, right? This quantification allows you to adjust your risk correctly, taking smaller risks when volatility is high and larger risks when volatility is low to maintain consistent risk. Now let's pause on this part. Let's go to the Pro Pivot Indicator, and we'll talk about one of the first things what was just discussed there. So taking smaller risk when volatility is high and bigger risk when volatility is low. That's what it just said, right? So I want you to imagine this. Okay, you see right here. Right, this is your ATR. This is your average true range. Right. Whenever this number is statistically high, meaning you can see the difference here. If I was to pull up, let's say Cisco, right? When we were looking at Cisco just the other day, right? Cisco's got $1.15, right? In comparison to the SPY, which has $5.55. Or if I was to pull up Tesla, right, we have $11.19, right, right here. Okay, and you can just look at the deviation as well if you want to, right? $20 deviation on Tesla, right? $10 deviation on SPY, all right, and a $2 deviation on XLI. Okay, so just using those as an example here. So what we just read is the same as saying if this number is like statistically high, so look at all the things that you trade and which of those things is the most volatile, right? The most volatile things that you trade, you use the tighter stop. You bring that risk down a bit, right? Why would you use the tighter stop if they're more volatile, right? Well, the tighter stop it's all based on the range anyway, right? So when that volatility expands, so does the stop, right? So you can see here it's 0.63%, right? For Tesla, it's 1.93%. You see that? So naturally, you have right, you naturally have a tighter, a bigger range, even if you're using the tighter stop. Okay. So now, if I was to go back to, all right, if I go back to the SPY, you see here my wide stop is 1.27%. Again, let me go back to Tesla. Right, my tight stop 1.93%. I go back to the SPY. Right, my wide stop 1.27%. So I can use a wide stop on the SPY, and from a percent, percent risk, right? As far as like the asset that we're trading, still not be taking as big of a risk with my capital. Okay, so that's essentially what we just read here. What did it say, right? So, where is it at here? So, right, taking smaller risk when volatility is high and larger risk when volatility is low. Now, this also means that when volatility expands, so at some point, the ATR for SPY or the standard deviation for SPY may end up doubling because the market's just moving a lot. Then you can switch to the tight range for SPY, and you may opt to do something different with Tesla, like trading debit spreads or something of that nature, right? That cuts down your risk in other ways. You see how that works? Now, the dynamic nature of volatility, right? The Bollinger Bands to start off with. So the Bollinger Bands, it's an indicator. It offers the most direct visual representation of the continuous cycle of volatility, expansion, and contraction. It's utilizing historical or realized volatility, right? That's derived from the underlying concept of standard deviation. All right. Now, if we're using the Pope Pivot indicator, your standard deviations are always right here. Okay, but we'll talk about that in another set. Then you have your deviation right here. So this is your actual deviation. So you'll always know what that number is at all times. Okay, now the first phase is volatility contraction. That's the first phase, volatility contraction, visually characterized as the Bollinger Squeeze. This occurs when the bands narrow significantly, moving very close to the price action. Let me show you guys what Bollinger Bands look like, right? Let's go over to Google real quick. All right. Let's go type of Bollinger Bands, go to images here. So these are Bollinger Bands here, right? So, when it's all said and done, all right, these are Bollinger Bands. All right. Now, when it's all said and done, these Bollinger Bands are, you have your 20 period moving average down the middle for the most part. So this is your 20 MA. And then this is telling us what the average deviation has been. This is what the average deviation has been. So, as this starts to get more narrow, volatility is tight. Then when we start to finally break out, you can see it expands. It gets wider away from the 20 period moving average, right? So you see a squeeze right there. You see a squeeze right here. Then you have your breakout that comes out of that. We'll talk more about that in a second. Okay. When it's all said and done, sorry about that. When it's all said and done, you start with the squeeze. So that's when the bands are coming in. So this narrowing signals that the price has been moving within an exceptionally tight range, right? Translating to a period of low historical volatility. Now, the trading implication here is critical because low volatility is typically followed by high volatility. The squeeze suggests that volatility expansion is imminent, right? Although the indicator itself remains non-directional. Give me 1 second, guys. right, sorry about that. All right, now, so what they're saying here is whenever this squeeze occurs, right? As a trader, you can start to expect a breakout is coming at some point. Now, you don't always know the magnitude of that breakout, right? But what you do know is that markets are not going to stay in a contraction forever. You know that much. Okay? So I built something new into this particular pro pivot indicator. I want you guys to keep your eyes right here. So notice that notice that there's really nothing there at the moment, right? But the minute you get to a point where a squeeze is happening, watch what happens. Let's go back to XLI. Right? Now it'll give you a little signal that signals a squeeze at the top here. Right? So whenever you see that pop up there, you know that a squeeze is happening. Now, in the future, this may end up having its own signal here. I'm just watching to see which one of these are going to be the most useful for you over time. It's either going to replace the 200-day baseline or the 50-day baseline. It's going to replace one of them, and it's going to create a squeeze signal right here. But for now, it's only going to pop up when a squeeze is actually happening. This helps because I know sometimes you guys don't really notice the bold numbers here. Okay, so when that time comes, you'll be able to see the squeeze and act on it. This does not mean that your squeeze. This doesn't mean that your breakout's coming immediately. But that's what you start to prepare for. You start to plan for it. Okay, so now that I know I have a squeeze, right? You start to work on that, right? Now, conversely, volatility expansion is signaled when the Bollinger Bands widen dramatically and move far apart from one another. This widening signifies that the price has recently executed large, fast moves in one of both directions, establishing a period of high historical volatility. The trading plan implication here is that such high volatility is not sustainable indefinitely. Right? Consequently, the wide bands suggest the market is approaching a point where it's due for a contraction. Okay, a shift back toward a period of slower consolidation. Consolidating or mean reverting price movement. Right. So we're either going to fall into a range bound market or we're going to pull back to the averages. That's what they're basically saying. Right. So this continuous cycle guides traders in anticipating shifts between periods of tight range bound trading and powerful breakouts. Right? Does anybody have any questions on the Bollinger Bands first? Any questions?
Yeah, just on what you just described by the expansion. That could be either a parabolic move or hitting R2, R3.
Yes.
Okay.
You're hitting R2, R3, or you're hitting your fourth, third deviation, second deviation. So I'll show you one right now. I was looking at this earlier today. Here's Dollar Tree after the move that they made earlier. 1 second. What they got going on here?
Yeah, that would be perfect to look at, especially after that big story. Was it today or yesterday?
Yeah, what's today?
Today. Yeah.
What is going on here?
You've already what terms did you use it?
A gazillion? But no, it wouldn't matter because we're using Google data.
All right.
Let me find out something else is going on. Let me close some of this stuff. Is something else going on? Uh-oh. Hmm. Very interesting. Let me check something real quick. Hold on. Yeah, it's definitely on my end. There's something going on my end. Give me 2 seconds. Just like that, I work magic. You see it. Let's keep going. All right, Dollar Tree. Well, let's see if I actually work magic. Actually, we don't know. Let's find out. Okay, looks like I worked a little magic. There we go. All right. um. Okay. So as you can see, oh wow, that was a decent pullback at the end of the day there. Real decent. So Dollar Tree was at the fourth deviation today. Right. I think it's because the
Really? Okay.
yeah. But I think it's because the day kind of like so basically they were over 125, so they were actually well above the third deviation. They were at the fourth, but the fourth is a little wider now after today's close, right? Your deviations update before your pivot points, so always remember that. So yeah, as you can see, they're at 122 right now. All right. Okay. So any other questions on deviations?
So you're at least so the new feature will just show squeeze and not expansion.
Yeah, no. So
Okay.
If it's not showing a squeeze, then you're likely, in either a normal market or you're already in an expansion.
Understood. Thank you.
Problemo. So Jube, what's up, Issachar? All right. Okay, now, yes, bold on deviation means breakout likely. And let's reword that, right? Let's see who we got here. Shout out to Bad No. Shout out to Bad No for the follow. And so let's reword that a little bit, Justin, right? Bold deviation means that you're currently in the midst of a volatility squeeze. right? Meaning it's the tightest form of volatility contraction that you can possibly think about, right? And what you're dealing with is the amount that you're deviating away from the moving averages is less than the average move that you're getting in the market over that same period. Let me say that again. The amount that you're actually getting up off of the averages is less than the amount that you're actually moving on a day-to-day basis. So let's say on average you're moving $10 a day, but on average you're only getting $5 off of the average, right? Off your moving averages. So it goes to show that you're not really actually doing anything. So it suggests that you're due for an eventual breakout of that range. And so what would be very important is if you start to note what that range is, right? So that's why I always tell people, if you notice, I always tell people, the first thing you might want to do is identify the current range that you're trading in if you're trading in one, right? So that means if I go over to XLI, right, as you can see here, you have your bold deviation and you have your squeeze here. So whichever one catches your eye and lets you know what's going on. All right. So let's go over to XLI here. And we can see, right, we're trapped in between this high right here. All right, these are our two extreme points right here. This high and this low. Those are the two extreme points, but you can see how it's pretty much just been a range. See that? See, before I really zoomed in, you wouldn't even been able to tell it was a range, before I zoomed out, right? But now that I zoomed out, you can see the range. You can just see it's just been going sideways for industrials. Right? And our system was able to detect that without even having to look at the chart. That's the beautiful thing. We didn't have to look at the chart, and we knew they were trading in some type of a range. Or if it's not them trading in a range, it's them coming down out of an expansion at a rate that that's probably significant statistically, right? Or so basically a huge drop off in volatility, pretty much. We actually saw that signal. What's up, Terrence? We actually saw that signal just before the SPY broke down recently, Justin. So we were able to prepare for that a lot better as well. All right. Any other questions on the deviations?
May be happening.
Right. Exactly. Right. It's definitely a warning. All right. Now, volatility and the average true range cycle. Let's talk about this one here. All right. So the average true range is a powerful indicator that provides a clear numerical measure of volatility by directly calculating the average size of an asset's price range over a specific period, right? So Justin, when you look at this, and this goes for anybody else that didn't know this already as well, when we say the average amount we deviate off the average is not as high as the as the range that we traded in. Well, now you can see based on this, what we're really saying is your standard deviation is less than your average true range. It's a beautiful thing. All right. So the first phase in this cycle is volatility contraction, same as the deviations, right? Which is represented by the ATR line declining to recent low levels. Now, for us, your ATR is right here. All right, this is your 8-day average true range. We use the 8-day average true range as a leading indicator for volatility. Okay, so in this particular case, so in this particular case, you're going to see multiple things here. So you'll see this 8-day average true range changing. I'm sorry, 1 second. All right, sorry about that, guys. All right, so yeah, as I was saying, so we use this so this one right here is your 8-day range. You'll never really see the 20-day range on here. It's here, but you'll never really see it, right? Because you don't actually need it. This 8-day average true range will actually tell you everything you need to know about your 20-day average true range. So you'll notice that this is red sometimes. That usually means that you're in an expansion period. When it's not red, you're in a contraction period. So you can see you got a squeeze going on, and your 8-day average true range is lower than your 20-day average, is lower than your 20-day average true range. So that expansion has not happened yet. That's what's going on here, right? So then when that expansion begins, right, what happens then is, let's see if we can, matter of fact, I know Dollar Tree had it, right? When that expansion begins, boom, right? This will turn red. And that lets you know that that lets you know that over the past 8 days, your average true range has has actually picked up above your 20-day average true range. So it's a really great signal to get you an early signal. Now, I have plans to potentially make this an even earlier signal later on down the line. I'm thinking of, potentially the 3 or 5 day average true range as a signal. But that's something I'll work on and check out later on and see if it works. Now, again, keep in mind, guys, none of this stuff actually changes from a fundamental perspective, right? So it would work exactly the same, but I may say, okay, you know what? Let me see if I can get an even earlier, because my goal is to get an earlier signal for you, right? So I can get an earlier signal for you by maybe having the market give us an early signal when the range starts to expand immediately. So those first 3 days when the market starts to pick up, boom, 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 right? Maybe we can see the range pop out above the 8 day average, the 8 day average range or something of that nature, right? So we'll keep it in mind. All right. Now, let's get back over here. Now, this decline signifies the market is quiet and the average daily movement or the range of the asset is shrinking. That's the volatility contraction, right? The trading implication of a low ATR is that it signals a state of compression. This compression is often followed by volatility expansion, a large sustained price move as market energy builds up for a breakout. And that's what I meant, Justin. See, as it builds up for a breakout. Now, the longer your contractions happen, the bigger the breakout's likely to be. All right. That's something that, we learn over time. All right. Give me 1 second, guys. Yeah. Let them go to the club. They'll be all right.
We've been unfollowing everybody, so
let them go to the club.
Baby.
They'll be all right.
You unfollowed your Stockfoot homies.
Yeah, they'll be all right.
Everybody.
All right. Now, so where were we at here? Okay. So conversely, volatility expansion is represented by the ATR line spiking to recent high levels. And that's what that other signal is all about. Like I said, when it turns red, what we want to do with that is, like it says, it's spiking to recent highs, right? So if the 8-day range is $2 and the 3-day range is $2.50, you can see the expansion. And that's what we try to bring with that particular signal. All right. Now, this surge signifies that the market is highly active and the average daily movement of the asset is rapidly increasing. The trading implication here is that while the market is seeing intense movement, this high level of volatility may be close to exhaustion. Consequently, a high ATR indicates a potential volatility contraction is near, suggesting a shift toward a period of rest, consolidation, or slower price movement. Traders use the ATR's quantitative output to objectively gauge the market energy and anticipate shifts between compressed and expanded volatility states. Now, magnitude is greater than direction. These are your key takeaways. Magnitude is greater than direction. Understanding the range of movement is more critical for survival and consistency than guessing the direction. Does everybody understand that part? Like, you can try to guess the direction all day, but okay, what if you're like, okay, yeah, I think the market's going up, but it's in a period of contraction, right? Or it's currently just started to contract. You can see how that clearly may not work out the best. You may end up buying the market just at the moment where it's likely to pull back on you. Right. So you wanna get that heat up, that heater going, right? You want to get that signal going that shows the market starting to heat up, right? Now, quantification. Volatility is not a feeling. It's a math problem solved via standard deviation. And there's the cycle. You must always consider whether current volatility is expanding, right? It's a high market fear or uncertainty, or contracting. It's high market calm and certainty. Let me ask y'all a question. All right. What I just spoke about a second ago. How many of you guys think you're gonna use these particular signals on a regular basis? How many of you already do? Right? Who of you actually looks to see if you have um this squeeze signal, or whether or not the ATR is in red, meaning it's in an expansion phase. Who actually looks for those?
I do.
You do, okay. Now, the reason I'm asking that question, so if that's the case, then you would be interested in potentially getting an earlier signal if you could.
Absolutely.
Okay. Let me write that down. Yeah, definitely. So Justin, you definitely want to use your different tools along with this. Right? You definitely want to use your different tools along with this. All right. So let's see here. So I wrote that down. I'm gonna start testing that. I'm gonna start testing that next week. So I'll probably have that to you guys by next week, Friday, because I obviously, like what I usually do. I usually test it throughout the week and then, go ahead and dish that out to y'all by the end of the week, so that way y'all can, y'all can benefit from that there, right? Now, um, the toolkit, as we already talked about Bollinger Bands and ATRs. You can look deeper into that all you want. So there are things here that we're going to be skipping through, so we don't have to read through the whole thing. By the way, all right. So have no fear. um, let's get to the good stuff. All right, analyzing regimes, expansion and contraction. All right. Um, mm, all right. Actually, let's move over here, right here. All right. So, direction and volatility strategies. Let's talk about these. All right. Now, so breakouts, trends, ATR usage, macro drivers, direction of volatility trading seeks to capture range expansion. This is the concept that price will move from a period of equilibrium to disequilibrium. All right. So, the breakout. The breakout. A fundamental breakout strategy relies on the market moving from low volatility to high volatility analysis. Look for consolidation patterns, triangles, rectangles, where the ATR is decreasing, right? Remember, when you start to see the ATR, contract, when that starts to happen, you're likely to see patterns forming in the market, right? So, like I said, triangles, and so on and so forth, right? Um, and when it says rectangles, what it's talking about is just straight flat consolidation, like what you saw in XLI, for example, right? You start to see the market kind of boxed in that regard, all right? Now, the ATR application. When price breaches a support or resistance level, confirm it with an increase in the ATR, right? A breakout on low volatility is often a fake out, right? A low volatility breakout is often a fake out. I think when I get you guys that new version, that's going to be one that's really going to help out, because you that signal will come on and off a lot more often, right? That blinking from red to from red to no signal will come on a lot more often, and so you will be able to see more often when it's breaking that key point, and it's that's gonna work out in your favor there. Now, um, macro drivers. Broad market volatility is usually driven by macroeconomic data, CPI, interest rates, GDP, or geopolitical shocks. Professionals anticipate the transition from low to high volatility by marking these events on the calendar, right? And these are things that we've always talked about, right? So at times we may say, okay, what do we have coming up? Say, okay, we got CPI coming up, or we got whatever whatever we got on our calendar. And then we may say, okay, cool. When that comes up, we're gonna look for the market to break out of that range, right? And as it's breaking out of that range, we're going to as it's breaking out of that range, we're going to assess whether or not volatility is expanding or contracting over that period. One of the most important things is going to be when. So imagine the market is breaking out, one of the most important things is going to be that we're gonna now attach this to the current day's average range as well. So that way it gives you more of a shorter term, immediate signal as to what's going on. So that's going to be something you'll be able to track a lot more often, right? So it's just really just a breakout with an expansion in the ATR. Okay. So if you get that going on, you might just have something. Now, in the most recent few days, we have noticed that you know, you know, we're getting this. You see this volatility contraction happen right here, right now. I want you guys to start noticing the contractions that are happening on your charts as well. So keep that in mind. Right, when that starts to happen, you'll be able to identify that a lot more as well. So, it's more like saying, okay, over the past 2 days or 3 days, we have less volatility than over the past 8 days, which kind of brings everything a lot closer in, right? So you got to break out of here, but now on the day, that fails as well. And, lo and behold, our 8-day average range is lower than our 20-day right at the current moment. All right. So, coincidence or not, that's the question. All right. Now, then you have your volatility, persistence or the trend. So I use a super trend as an example all the time with your with your chandeliers and things of that nature. So, basically, as long as the price is not reversed by more than 3 times the ATR, then you're good. We've already worked that into our 8-day trend and our monthly trend. Right, it's already worked into the system now. All right, so no need to worry about that. So go back to SPY. All right, so when it's all said and done, as far as the SPY is concerned, just kind of using this as an example. Wherever we are, right? Wherever we are, we're always looking for these 3 ATR moves from the highs or the lows, right? And as long as price doesn't, as long as price doesn't break these levels by these amounts, we're gonna be just fine. We use our stop loss in that regard to do the same thing. So your stop loss is more based on the previous day's high, where, or from the current day's high, where your 8-day trend and your monthly trend is more based on the average price that you've been getting over that time period. Right. Your key takeaways from these particular elements is, that the best directional trades start from a period of extremely low volatility. That's going to be the number one thing you guys are going to be looking for. Look for the moments where, doesn't mean that the market has to be just not moving at all, not going anywhere. But look for those moments specifically where the market is not actually breaking out. Every time it tries, it fails, and things of that nature, right? Then you look for a valid breakout, right? Should the you want to see the price expanding, and the volatility expanding with it, and then you use your ATR stops that we just put in, right? To just ride a wave, right? your wide stops if you're dealing with low volatility, your tight stops if you're dealing with high volatility, right? And when we talk about volatility, we're talking about the stock that you're actually trading. So basically, you're going to look for these low volatility moments. You look for a breakout. When the breakout happens, you use these wide stops and tight stops to just keep you in the trade the whole time until it finally breaks to a point where you're done. Right? When these levels are finally broken, you'll be done. Eventually, like I told you guys before, we will start to trade, those 2 and 1.5 and 3 deviation stops. But for now, this is where you're at. All right. So this is for your trend. All right. Overall, but this is your early warning of an end to the trend. All right. When it's all said and done. All right. Any questions on these elements before we talk about? Matter of fact, let's actually we're gonna save the other ones for Tuesday and Wednesday. Let's focus on what we just learned here. We're gonna save the rest of this for Tuesday and Wednesday. Let's focus on these parts here. All right, and let's go over some examples actually. All right. But let me just see if y'all got any questions first before we start running through examples. So good, Justin. Well, you gotta start with a few questions. Okay, when you say volatility, do you mean volume? No, I mean volatility. Right. So on the pro pivot indicator, your deviation and your ATR represent your volatility. These two numbers right here represent your volatility. These two numbers right here. Okay. Now, when we talk about volatility contraction, right? We're talking about moments where these numbers are historically low, right? Where they're historically low or they're coming down. Let me pause on that part. Does that make sense to you so far? Just want to kind of break it down to make it a little more clear for you here. All right, your deviation and that number right below your deviation. Right, yeah. So now we're looking for periods where these numbers are actually historically low. Those are going to be the best. Those are going to be the best opportunities we find. Okay, where these numbers are historically low are going to be the best opportunities we can find, but you're not going to find them all the time. Sometimes you're just going to be trading a normal market, right? When these numbers are not bold and when they're just normal, we're just trading a normal market. All right. So this is just normal volatility that we're dealing with at the moment. Does that make sense? Let me pause on that part. All right. If these numbers are not bold or red, it's just normal volatility. That's what we're dealing with. Does that make sense to you? Okay. Now, this ATR right here, this one that's below the deviation, this the smaller one right here. Now, this smaller one is connected to everything, Justin. This number right here is connected to everything. Let me show you what I mean. If I change this number right now, you ready for this? Watch everything change. Everything just changed. You see that? Everything just changed because I changed that number right there. That number, and notice it turned red when I notice it turned red when I moved it to 10. Right? Because you're dealing with normal, right? Complacent volatility. And this number could be coming down. If this number is still coming down, then you're still contracting, right? Now, so you saw how that number changed everything. So when this number goes up, all of your risk that you're taking shifts. Now, we're not controlling this number. This number is based on what's happening in the market, Justin. It's automatically taking everything that happens in the market and calculating for us how volatile the market is. And then as somewhat of a warning sign, right, it just shifts things for us. It says, hey, the market's more volatile today. You may want to see the market break above 688 instead of 687.57. It'll do that for us. Okay? Now, over the long run, what you're going to start to learn, that every trend you want to follow follows this number right here. Every trend you want to follow follows that number. The question is, by how many times? Typically, 3 times that number is enough to keep you in almost any trend. I repeat, typically, 3 times that number is enough to keep you in any trend. Right? But of course, right? This is like saying the S&P 500 has to pull back by like $18. Right? I repeat, this is like saying the S&P 500 has to pull back by like $18 or $17.
So will we need to calculate that to see
No,
the 3 times, or
no,
how we know? Just keeping track of it, or
nope. I already built all of it in for you. Right? So, see
what
right,
is 3 times?
see right here?
Mm-hmm.
Look up here. Look at the formula.
I see it.
All right? You don't have to do anything.
Okay, so yeah, I'm just knowing that this is tied to those 2 numbers. So
Bingo.
okay.
Okay? It's already built in. It already does all the work for you. I'm just telling you the formula so you understand it. Right? So now, let's say the market starts to fall right now. As long as the S&P does not fall below 670. See right here? See this number right here? Your short term, well, let's not say, let me rephrase that. As long as it doesn't close below 670, your trend is still running. So all we did was take our volatility and turn it into a system. We took our volatility and we turned it into a system. As long as it does not close below this number, your short-term trend is still to the upside. So if we pull back next week and we stay above 670 and we start to bounce off of that number, you got yourself a friend. You got yourself a friend. You go ahead and handle your business. Right? Now, for example, remember we were talking about the micro trend recently, Anisha? Let's use this as an example. Imagine market's dropping. It's dropping. Boom. It hits, let's say, 672, and it bounces and it pushes back above the micro trend and back above the weekly pivot. all of a sudden we got some. Right? The biggest thing is that it never closed below the 8-day trend. That's the biggest thing working in your favor is that it never closed below that number. If it did, we would have to start looking for lower highs. We have no choice. If it closed below this number, then you say, okay, the next time the market bounces, I'm going to look for resistance at the weekly pivot probably. Right? I got to see it get back above all that first. And you may have a nice trend that you can trade in the short term, right? Little micro trend. But until you get back above this number and close back above this number, your trend isn't back to the upside yet. Everybody understand that? All right. So this is your volatility put in two figures. You can start by looking at just this one right here and just practice it. Just practice. Because it's shorter term and it's going to happen more often. So practice it. Watch the market pull back. Does it break this level? No, it didn't break this level. When it bounces, does it get back above this weekly pivot? Does it get back above the micro trend? If it does, great. If it does, great. I can now continue to take the trade to the upside. This is like a trend continuation signal, right? We don't want to use this like a reversal signal. We want to use it as a trend continuation signal. We use it as an opportunity to say, if this never breaks, I keep taking the trade in the same direction. I keep going until it breaks. Does that make sense to y'all? Until we close below this number right here, until we close below this right here, I will continue to take long positions to the upside. Every time it drops and it bounces without closing below this number, I'm going long. Now, all I need is the signals to go along with that. This part is not your stop loss. Your stop loss will stop you out, right? See right here? 679. Your stop loss will get you out there before you hit this number. But let me be clear about this, Justin. You can use it as a stop loss. So yes, you can use it as a stop loss. It all depends on how big you want to go. So you can use this as a system all in its own. So let's say you wanted to say, okay, rather than, using multiple parts of this, I just want to use this one part of the system. But what I want to do is I want to go long the first signal I get, and my stop loss is going to be right here. If I ever close below that, I'm out. And not only that, I start looking for short positions. I don't go short immediately, but I start looking for short positions. Cool. I get a short, I take the short, and I stay in that short until this is closed above. So yes, you can do that 100%. But these are your actual stop losses. So these are your stop losses for bullish trades, and these are your stop losses for bearish trades. Okay? Now, these stop losses right here are based on the highest high and the lowest low that you hit. That's why these are better stop losses. So this would stop you out before you actually hit this number. Then you get to sit back and watch and see if it actually breaks it, if it actually closes below it. You see? So our stop losses are actually early warning signals. 1 times the ATR or 2 times the ATR ahead of breaking this number. Does everybody understand that? Right? So our stop losses warn us before we get to this level.
No. Sorry.
I'm talking about the bearish key level on the 8-day trend. No problem, no problem. Now you Division 1, you should understand what that means. I'm joking.
No pressure at all.
No pressure at all. Any other questions before we, any other questions there? So now that this kind of breaks that down for you, right? So you see how your average true range is working through all these. So all these right here, ATR. All these right here, ATR. All these right here, ATR. Your ATR is working through all these. Your micro trend is the ATR. So that's why this was such a big session, guys. Because the ATR is this is our best friend in the world of trading. Let me tell y'all something. This 55-day range uses the same components as the ATR. It's a very similar formula, which is why I was so hell bent on putting that in here and taking the RSI out. Right? No, I still keep the RSI on my chart. Just like Justin, he says he's going to use his MACD. We still use our other indicators, right? But this will definitely help. Okay. So that 8-day trend is going to be one of your favorite ATR indicators. All right. It's a beautiful thing. And then your monthly trend, which is still up right now, by the way, because we never closed below 644 recently. So that means we're still in a long-term uptrend as well, according to these standards here. Right? So until we close below 644, nothing has changed for us. All right. So you say short-term trend, medium to long-term trend, right? Or you should say short to medium-term trend, right? Or short-term trend and momentum versus long-term to medium-term trend here. However you want to work that. Do you guys understand those volatility expansion and contraction concepts? Do you have any questions about it? It's good. It's a car. I see you. I see you. Some noted. What's up, Chili Mo? Okay. So, okay. So it seems like you guys got all that down packed. What about the two strategies that we just discussed? Everybody got that down pat? Maybe. Hmm. Maybe we can find something that let's see here. Okay, matter of fact, let's use Dollar Tree. Let's use Dollar Tree as an example here. All right. What's up? What's up, man? All right, let's use Dollar Tree. Okay. I'm gonna get rid of this real quick. Rid of that. So using Dollar Tree as an example. As you can see, we're already at our second resistance here. We almost hit our third resistance today. We're very close. We hit a high of 125.74. Okay, we're very close. So the record of not hitting third deviation, third resistance stands. But we did hit our fourth deviation earlier today. So you know you have really two options here. You try to short this thing because you see it as being overextended, or you say, you know what? Well, it's got a strong trend going, and I want to trade that trend continuation. You do one or the other. So here's what I'm really trying to say to you guys: these two create your floor. Right? So pretty much 107 to 101. I say, okay, cool. Now I'm gonna use a box in this regard. All right, just for simplicity's sake. All right, let's say 107 to 101, pretty much. So this area right here. All right. So being that I'm using a box, and the high end of this box is where my 8-day trend lies, and the low end of this box is where my monthly trend lies. It's pretty much like saying if we were to ever close inside this box, right, that the short-term trend is done. And if we were to ever close below this box, the long-term trend is done. It's pretty much what you're saying. All right. So when you look at these two right here, all right, that's pretty much what you're saying. You're saying, hey, if I ever close, all right, outside this, we're done. Now, if the market happens to, let's say, fall to this level, see like right here, see this pullback right here? Let's just imagine this is happening as of recent. So the market pulls back and bounces here. That's what I'm talking about right there. You want to take that trade right there. That's the trade you want. Right? You want the trade that comes back to this area, never closes in or below this area, and then bounces. That's exactly what we're saying. Does that make sense to you guys? Did that clear that up for y'all at all? Did I make that more clear for y'all? That's exactly what you're basically saying. When I said, hey, you just want to keep, right? You want to keep going at it, right? Keep taking that upward move. So that's exactly what we're talking about. Right? So as long as you never close in or outside of that to the downside, the next time that bounces, I want to take it. I want to take the trade. But I want to look for the pullback though. Right? So at the same time, I want to pull back in Dollar Tree. That does not break below, right, 50 or 50 to 40, right? So it stays within that 50 to 40 range, right? So it never goes below that range and then bounces from there, right? So let's take a look at Dollar Tree real quick on the Trader cheat sheet real quick. Where is 50 on the RSI? 50 on the RSI, look at that, is 106. Let's come over here real quick. Look at that. Is that not interesting? Come on now. So pretty much this is saying the next time Dollar Tree falls, it needs to stay above 50 on the RSI, right, on the daily chart here. That's what it's basically saying to you. The next time it drops, it needs to stay above 50 on the RSI. And if it does that, bing, we got it. And so this is why I always talk to you guys about, like, know what you're gonna do ahead of time. Know what you're gonna do ahead of time. Now, let's see what we got going over here. Okay, look at this. The weekly pivot is 107.41 right now. We don't know what it's going to be next week, right? So maybe we fall and we hit the first support next week, or we get right around the weekly pivot. Who knows, right? But either way, maybe we fall and we find some support at our pivot points. Look at our 20 MA. Look at it, 106.42. All right, 106.42. What was our 50 on the RSI right here? 106.30. Look at how amazing that is. Y'all think it's a coincidence? Anyone? Coincidences? Come on now. So everything's lining up. So if they pull back, they hit around that 50 on the RSI mark, and they bounce from there. If that happens, right? If that happens, all you need to see is them either bounce off a support level, right, and start to push back to the upside from there. A few things I would look for right out the gate: a bounce back above the micro trend. All right, now the micro trend is going to be different when it finally hits 50 on the RSI. All right, so always look for a bounce back above the micro trend, guys. Always. All right, let that be a standard for you from now on. So it hits 50 on the RSI. The first thing you do is check what the micro trend is. Boom. All right, if it bounces back above the micro trend, that's signal number one. All right, in this particular case, does it stay above the 20 MA, or does it get back above the 20 MA? And the other thing is, remember, when the current price is green, we're above the previous day's high. When it's red, we're below the previous day's low. So maybe at least getting back above the previous day's high. You may not be above the weekly pivot when this happens. Why? Because the weekly pivot is likely to move higher because of how big today's trading day was for Dollar Tree. Right? But if you want to wait till you get above this weekly pivot, you could do that as well, and you likely get your breakout swing. So you might also say it falls, it hits 50 on the RSI, and then it picks back up to give you a breakout swing signal. That works as well. But with me on that? All right? It falls, it stays above 50 on the RSI, or at least, if it taps 50 on the RSI, and then it bounces from there to get back above the breakout swing, all without closing below 107. That's the key. All without closing below 107. All right, pretty simple stuff. Any thoughts on that? What's up, Moji? So Dollar Tree is a good example right now of like one that has a trend going, and then now you can see how the ATR will keep you in that trend. All right. Same goes for the market. Same goes for what's happening in the market right now. All right. Whatever pullback you see, just as long as it doesn't close below that level, you're good to go. It'd be safe to say that those two numbers are basically a yes. Yes. It's a built-in demand zone. It's more of where demand, it's more of where you should expect demand. And so if you don't get any demand at those levels, you know something's off, Justin. Period. If you don't get demand at those levels, you know something is off. Like it said, let's go back over here. All right, like it said, where was it at? Right, macro drivers. So broad market volatility is usually driven by macroeconomic data, CPI, interest rates, GDP, or geopolitical shocks. Okay, so if you're not holding those levels, something's likely changed. That's that's forcing the market to break those levels to the downside. All right. Any other questions? I'm gonna stick around for another 12 minutes. Let me know if I got any other questions. We'll close out at 10:30.
Came in a little bit late. I'll catch up on replay.
Definitely. We're gonna be going over some more of this on Tuesday and Wednesday as well. But still catch the replay though. And I will be uploading this to YouTube for those that are watching now. All Pro Pivot sessions get uploaded to the YouTube. This is good stuff though. Cool. I mean, I guess nobody has any more questions, so we'll go ahead and close out then. Did anybody learn anything new about the Pro Pivot indicator today that they didn't know, or anything new about the Pro Pivot indicator, or that's been added that you feel like it's going to be a good you know okay, I see. All right, cool. Nisha says she knows something new.
Learning something new every time.
Excellent. Cecily, what did you say there?
I'm sorry, I didn't mean to speak over Anisha. That squeeze signal is a nice addition.
Excellent. Appreciate it. Christopher?
Yeah, I had a question. Where's the Pro Pivot calculator? Is that in the subscriber form?
No. I will put a link in the subscriber forum for you right now.
Okay.
1 second there.
Ooh.
All right, it's in there right now. I'm putting it in the in both channels there. Now, yeah, and it works. It works with Google Sheets, not Excel. This is not an Excel sheet. It's a Google sheet.
Okay. Yeah, I use Google Sheets most of the time anyway.
All right, excellent. I think there's 2 more copies available at that current price there anyway. So
Is there 2 cards?
Now, anybody else have any more questions? And Christopher, you'll notice that there's a link for tutorials that's going to be there as well. Ah, good question, Justin. Check me out. See right here? You have bullish auto TPs. You have bullish auto TPs that are actually and bullish and bearish auto TPs that are built in for swing traders. So if you take a swing trade, the minute you take the trade, you can lock in these take profit levels right here. And so every time you hit one of these TP levels, what you want to do is, take profit and then mark the current price at that point. So these are going to automatically update as the price moves higher and higher or lower and lower. So yes, we got TPs built in as well, my guy. Also, you want to use first, second, and third resistance as TPs, or you want to use your deviations as TPs as well. All right, those are always good TPs. We had to have the TPs built in. And so with the tight stop, these give you an automatic 1-to-1 on your first TP. I'm sorry, 2-to-1 on your first TP, 4-to-1 on your second, and 6-to-1 on your third. With the wide stop, these give an automatic 1-to-1 on your first TP, 2-to-1 on your second, 3-to-1 on your third. So it has an automatic risk to reward built in as well, Justin. Automatic risk to rewards built in. Like, the only thing is, like I said, you got to make sure that you make a note of your so basically, let's say I took a trade on Dollar Tree right now, like right now, I would immediately write down 133 as my long-term target, right? As my medium-term target. All right. Then, like we said, you have your TPs here. So 121.65 is going to be my 121.65 is going to be my my stop loss. Hey man, you know what's crazy? You know what's crazy, Justin? I think I've been working on this for. I think I've been working on this for more than 2 years. I think I've been working on this thing for it's just getting to the point that I'm able to release it to the public. I remember Shay, are you there right now? Oh, I don't think she's there. I'm trying to remember. There was a day we were in
Yeah.
Okay. What was that day? Like, how long ago was that? I remember we were in Jeremy's room one day, and that was when I announced that I just started working on this thing. Well, not just started working on it, but I just started to let people use it.
I had it in 2022, man.
It's like way back then, right? Yeah.
Yeah.
Golly. So yeah, so that alone is 3 years, and I was working for it at least a year before that. So I've been working on this for like 4 years. Um, and now it's finally, it's finally here, man. Because I remember like everybody wanted a copy. How much is a copy? I want a copy. You know. Look now none of them can have a copy. Huh? Say, ain't none of them around no more.
Right. How people hear that?
Huh?
I said, most of the people that was bugging you aren't around anymore.
Yeah.
But a lot of us still here to reach the benefits, so that's all. Somebody's working that
Definitely.
used to the
Like what I used to do, Justin, is like she'll tell I would go into trading rooms and I would test it by helping people analyze stocks. So somebody would ask me about a stock, and I would just go to the pro pivot and I'd say, okay, oh, okay, I see we got this going on, this going on, this going on. You got some resistance here, some boom, boom. And then they was like, how you doing that so fast? And I was like, well, I told them what I'm working on, but so yeah, like everything that I have, I try to battle test it. I try to test it out, in real time with like, real markets. And of course, these wonderful folks of the Division One, they, they've always been the first ones to use all these products, and so once I got out of that testing part of the phase, then they started to test it out, and from their feedback, you have this, and yeah.
I don't know if the order went through.
I appreciate that, Justin. Um, some people never get that part, man. I'm happy you did, man. You know, I'm still trying to keep it that way. I'm checking right now for you, Christopher. 1 second here. Um, hmm, yeah, I don't know. I don't think it went through either.
All right, click it again. Okay, this time it went through.
Okay, gotcha.
Yeah, get to it.
Yeah,
Get the email.
yeah, it went through. So yeah, just like I said, so keep in mind that you're gonna see the uh keep in mind that you're gonna see the um there's a link there for the YouTube, right? Which I think you're already following me on YouTube anyway. So you'll see the Pro Pivot indicator videos that are gonna be popping up over there. And you wanna tap into those. Today's episode is going to be uploaded as well. All right. And so, by the way, guys, so that means that Tuesday and Wednesday, even though they're not usually Pro Pivot sessions, are going to end up being Pro Pivot sessions. So we're going to have 3 Pro Pivot sessions this week. Then, all right. Because this volatility thing, I'm telling y'all, this volatility thing, this is bigger than like.
it's coming.
Hold on 1 second. Yeah, this volatility thing is just it's bigger than anything, man. It's bigger than all of it. It's bigger than all of it. Like there's nothing bigger out there, in my opinion, right? Than what you can get out of the. It's nothing bigger than what you can get out of the like the understanding of volatility. You can understand this. Once I got this that was it. Like, for the record, this is where my calmness actually comes from, by the way, guys. My calmness really comes from this. This is it. Like the stuff that makes me like just straight up emotionless in the market, just like it either is or it isn't. It comes from my understanding of volatility. 100%. Right? I think we need to do one of those exercises on Tuesday. I think we haven't done it in a while. I'm gonna look for some participants now. So y'all better show up ready to ain't no shy ones out here now. So on Tuesday we're gonna look for some participants. No, maybe we'll do it on Wednesday. I'll look for some participants. So basically, I'm gonna be doing the simulated class joint where we do the height. All right. Everybody, we ain't even gonna do this. We ain't even gonna do this. I know the tradition is for us to do the height of the people in the room. But we're not even gonna be doing that this time. So no worries. You won't have to reveal that you often reach higher to open doorknobs. No. No worries. You no longer have to let anybody know that you tiptoe to turn on the sink. Okay. That you actually climb in the bath. All right, I'm done. That was the last one.
Yeah, and something at work was out of my reach. I had to break for a very.
Oh, goodness. Nah, but seriously,
Be honest with her. So good. Songs.
wow, I see what you did there, Moji. See what you did there. But yeah, so I think that a nice simulated class is gonna work. That's what I've been doing the past few ones. And see, guess what I do now? Now I have AI just do roll call with the height now, and so it just calls random names and random heights.
Okay.
Yeah,
We're gonna do this Tuesday.
I'm thinking we might want to do it on Wednesday. Is what I was saying.
Okay.
I was thinking Wednesday because and the reason why I'm saying Wednesday is because well, when it's all said and done, I think we still have a lot to discuss, and we don't want to like bury ourselves on Tuesday. For the record, please read through that PDF. Por favor. Read through the PDF if you can this weekend, and that way you guys can. So on Tuesday, I expect you guys to come and say, "Here's what I did not understand." If you don't understand it, okay. So please read through that PDF, and then for you guys in Division 1, of course, on Sunday you can let me know what you did not understand. All right. I know this is the biggest PDF we've had in a while, and it's not large print, right? It's so it's actually a lot. It's actually a lot. But once you start to realize, it's not as much as it seems. So all right, guys. I will catch up with you guys later. All right. I'll see you guys on Monday. Wow, we have no class on Saturday for the first time in a long time. So that means y'all, you know, that means y'all get a whole day to party. You know, check y'all out. You know, free for the weekend, huh? What y'all gonna do with y'all time? Hmm. At least free for now, I should say, because come January, all those who signed up for Portfolio Mastery, be prepared, okay? Because a new regime begins. So that's actually why I'm giving y'all Saturdays off, so y'all can kind of catch y'all breath before we start the Portfolio Mastery classes.
Right. All right. I think I have one question before you sign off.
Hmm.
Using the indicator and tying in Dow theory, as we're seeing things developing, accumulation or distribution, we can still, if we choose, take the trade ahead of public participation, right? We want to be a little more aggressive.
Yeah, I mean, listen. I mean, I'm sure you know. I'm sure you know me well enough by now that if I wasn't actually participating in the public participation as I am lately,
Wow.
that I'd probably be in awe of so many of these. But don't get me wrong, there's going to come a time, and I feel like everybody's going to be ready for that, right? And we're definitely going to rock. We're gonna definitely go with it. For sure, for sure.
Sweet.
So yeah, that time's coming. Like this XLI, I'd have been in a
You're reading my mind because I couldn't really listen. I heard you mentioning it this morning, and I was like,
yeah, I'd have been in a January 2027 by now. I'm gonna be honest with you.
okay.
With a it's a slight hedge to the downside. Because but we're public participation people now.
So, like, figure participation people now.
Well, yeah, like basically a pullback on XLI to like a key support level or something like that while it's still in that contraction phase. Magnifique.
Uh-huh.
That's what you need. That's what you need. Anyways, y'all go ahead and enjoy y'all night and enjoy y'all weekend. I catch up with y'all on Monday. All right. Everybody be blessed. Stay well. Laters.
Do so much later.
So, thank you and good night.
Good night, guys.